Let's take a look at some of the transactions and journal entries that started popping up here in Chapter 5. So we're going to look at an example problem. On May 1st, Artie LLC purchased $7,000 of goods on account from Arizona Company, terms 210 net 30 FOB shipping point. The goods cost Arizona Company $3,000. Artie LLC then pays $150 for shipping on May 3rd. On May 5th, $400 of damaged goods were returned. The damaged goods have a fair value of $50. On May 9th, Artie LLC pays Arizona Company in full, less the discount. So we need to journalize these transactions as Artie LLC, as the buyer in this situation. So let's look at this first one. Artie LLC is purchasing $7,000 of goods on account from Arizona Company, terms 210 net 30 FOB shipping point. So what this is saying is that Artie is buying inventory. They're buying these goods that cost $7,000. They're purchasing them on account. Those terms, which we read that as 210 net 30, meaning they'll get a 2% discount if they pay back within 10 days, or they have to pay the net, they have to pay all of it within 30 days. FOB shipping point means that the buyer has to pay for shipping. The goods cost Arizona Company $3,000. That means that these goods, for the seller, it costs them $3,000 to either acquire these goods from another source or to make these goods. So as the buyer, we don't care about that. So we're just looking at the first sentence. They're purchasing inventory. Well, inventory has to increase, so we debit inventory $7,000. And how are they paying for this inventory? It's all on account. So we will credit accounts payable for $7,000. Those terms and FOB shipping point does not come into play yet. Those will come into play down the line here in this problem. On May 3rd, Artie LLC pays $150 for shipping. So this is where FOB shipping point comes into play, because now the buyer is paying for the shipping. So they're paying $150 today. These shipping costs are just additional costs of acquiring this inventory. So we need to show that our inventory is increasing. We debit our inventory $150 because it cost us an additional $150 to get this inventory. Now, it says that Artie is paying this shipping cost right now. So we will credit cash of $150. On May 5th, $400 of damaged goods were returned, and the damaged goods have a fair value of $50. So they are returning these goods, meaning they don't have as much inventory now, so we'll need to decrease our inventory. And the amount of money that they owe Arizona Company is decreasing because they are returning some goods. So we want to decrease accounts payable by $400 and decrease inventory by $400. So we debit accounts payable and we credit inventory for those $400 amounts. This fair value of $50, that's what the seller can then get for this damaged inventory that they are getting back. So the buyer does not care about that fair value, so we can skip that in our journal entries. Now, on May 9th, Artie LLC pays Arizona Company in full less the discount. So we need to figure out what in full even means at this point. So we have this T account down here at the bottom of the screen for accounts payable. We initially had a credit of $7,000 to accounts payable, but then we debited $400 when we returned those damaged goods. So the current balance in accounts payable is $6,600. We want to get that balance off of our books, so in our journal entry, we will debit accounts payable for $6,600. Now, we paid back within the discount period. So, we will find that 2% discount off of the $6,600 owed. So we take that $6,600, multiply it by 0.02, and we find out that there's going to be a $132 discount. That discount, when we're the buyer, gets counted under inventory. So we credit inventory, 132, leaving us with one last account, our cash, the amount of money that Artie will have to pay Arizona Company is $6,468.